we saw a really, really good day, a really good couple of days.
Yeah.
Because of it. Mortgage rates improved significantly. Probably like a quarter point in a day.
Yeah.
Basically.
Yeah, no,
a quarter point in
accurate.
rate, which was significant. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Brock Lassick, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Okay, welcome back to the Loans Elevated podcast. We're going to let Ryan, since he has been out for a long, it's something like that. I wasn't counting, but
it was an early retirement.
He's been out for a while, so we'll let Ryan kick this one off. Ryan, go ahead.
Well, gentlemen, I think today we are going to be talking about the effects of tariffs on, and Trump and his policies on mortgage rates and real estate in general.
Yeah, he's not sharp today. We called it the Trump effect on real estate.
Trump effect on real estate. There we go. Thanks for that.
Throwing him right back into the fire.
Yeah, for real. So I don't know where we want to start off. I have the email pulled up from one of our colleagues at Cross Country that I think had a ton of good information that I was going to kind of read through. I was just trying to find the good talking points that we could start with. Maybe we even just start with the overall policy in general. So there were, I guess, teasers on how much the tariffs were going to be, and a lot of the media was talking about it leading up to the actual day, which was Wednesday when it all went down?
Yeah, Wednesday.
Yeah.
Which was,
what do they call it?
What actual date?
Liberation Day?
Liberation Day. Yeah. And basically it came out and went way above the mark, which caused a ton of shock to the stock markets, to, as we're seeing right now, Treasuries and bonds, and ultimately why we're seeing mortgage rates come down right now, because it caused a lot of uncertainty and fear in the stock market. Investors are selling off like crazy, taking profits from the stock market, because we all know that's been pretty bloated the last 5 years.
Did you see the video of the earnings call with Restoration Hardware?
Mm-mm.
And I think it was the CEO talking about the earnings. And it was as
like
Trump,
Restoration Hardware, like the furniture company?
Yeah.
Okay.
As Trump was talking about the tariffs, he's having his call, and he's like, we haven't seen the full effects of what the tariffs will have, but it's gonna. And I'm paraphrasing, obviously, but there's going to be some negative effects because they're importing all this stuff that's going to be subject to tariffs. And he's going on, and he's like, oh, I'm sorry. What was that? Oh shit! And you look at it. It dropped 25% in 1 minute.
Oh, shit.
The stock dropped 25% in 1 minute. It was
crazy.
Nuts.
Mm-hmm.
Crazy.
Yeah, so I feel like that's the initial effects that we're seeing so far. And I think the challenging thing is we don't really know the long-term effects of these. Also because the word on the street is this is just a negotiating tactic to kind of ruffle the feathers of the other countries that have been, I guess, more so in quote, unfair trade, which maybe we could agree with, but I don't even know if that matters, at least in regard to real estate in our world.
Mm-hmm.
So it was more of I think, hey, we're not messing around. Let's make this more fair and a win-win for everyone, and ultimately position the U.S. in a better spot.
Well, the bottom line is this. The people are freaked out that it's going to have the actual tariffs were completely unforeseen.
Yeah.
And the effects of those tariffs and the countermeasures from other nations is instilling so much fear. And it's creating a risk-off trade where they're saying, hey, owning these companies like Restoration Hardware, for example, where their products could become unbearably expensive for the consumer, and then now they don't sell anything.
As if they weren't already.
Right, exactly, right. But now they don't sell anything, so everyone is selling out of these companies and buying bonds because that's a safe haven. And believe it or not, like nations all around the world are having issues. So the safe haven still is United States bonds and treasury yields and mortgage bonds in our case. And both of them are getting favorably supported because of this tariff uncertainty.
Every time we see a crash or correction in the stock market, we see the bond market improve.
Yeah, exactly. Yeah,
It's going to be a flight to safety at every time.
Yeah.
Yep.
Unless we're talking COVID. But that was like the only
but there was a temporary drop
but everyone just went to cash.
Right.
It was all,
everything dropped.
It was all stimulus. It probably.
Yeah.
So yeah, that's the only time. And I was talking about that with a buddy of mine the other day, basically saying this is pretty normal. You see the stock market sell off like this, long-term rates are going to improve. You don't see low long-term rates in a booming stock market. It very rarely happens.
Right. They
work inversely, like we're talking about.
Unless the Fed messes around and there's quantitative easing, which is really
manipulation.
But we might get some of that back. And like we were reading on the Treasury account, there may be fewer Treasury yields issued because the Treasury or 10-year U.S. Treasuries or any type of Treasury, 10, 7, 5, 6 month, all sorts of different variations, fewer of those will be issued because they have a huge surplus in the Treasury general account, which will enable the government to be self-supportive. So that's kind of like a miniature version of quantitative easing. Right, it does.
Yeah.
Because there's less supply.
So if that plus what we're seeing with tariffs and flight to safety, shouldn't that just compound what?
Yeah, I think so.
Well, I think we've talked about this. I'm thinking about, guys, our old office in Cottonwood when we were talking about recessionary fears and flight to safety and global markets pulling money from their markets and investing in U.S. Treasuries and bonds. And that's going to bring lower mortgage rates. Now, it did take a long time.
Like 2 years longer than we expected.
See it. Yeah, but it's happening the exact way. It's these typical boom and bust cycles. It really doesn't take a super genius to kind of see it coming. Now,
well, and the interesting thing is that you're hitting on right now that I think we have supporting us is there's not an international place that's a safe place to put money that isn't suffering like the
equally,
internationally,
if not harder.
Exactly. They're suffering worse. And so now our money's not going to leave the U.S. U.S. money's not going to leave the U.S. for some other place because of these concerns with the administration in place now.
Right.
And other nations are going to be inclined to buy U.S. Treasuries and mortgage-backed securities. Why? Because there's way more risk in their markets and their nations than there is here. So it's like it could be a perfect storm for mortgage rates.
Yeah.
A lot of this geopolitical nonsense that's happening.
Yeah.
Yeah, I agree.
Well, let's dive into that just a little bit. Wednesday, we saw the best mortgage-backed security day we've seen probably year to date. We'll have to fact check that, but
we saw a really, really good day, a really good couple of days.
Yeah.
Because of it. Mortgage rates improved significantly. Probably like a quarter point in a day.
Yeah.
Basically.
Yeah, no,
a quarter point in rate, which was significant.
Yeah.
Well, and I think this is a testament to the saying that the real estate market typically gets hit the first when we're seeing an economic downturn. It's typically inflation, right? People are taking advantage of the gains in the stock market. Long-term rates are going up. That deters, a lot of buyers from looking into real estate because payments are going up, just like we've seen, right? And then real estate generally is the first one to recover right out of a recession or actually thrive in a recession because mortgage rates come down, debt is cheaper, people are looking to buy and move again, or refinancing comes back a ton, which frees up a ton of cash flow for a lot of people. It actually helps bring people out of the recession. Yeah. If we're talking like micro markets within a household.
And right now, because people have so much debt at such high rates and lots of equity, that could be a huge benefit to the economy. But one thing that I feel like is going to happen, we're talking about how this impacts mortgage rates getting better. But then when people, the psychology of just Americans, and I would say anybody, is when you watch your retirement account fall, which everyone's retirement accounts in the equity markets that we're saying are literally falling off a cliff. We're down, I think, 15% on the year at this point in the S&P 500, something like that. When people pull up their quarterly 401k accounts and it's dipped by 15% and continuing to go down, that's going to temper. Maybe we're not going to buy that new car. Maybe we're not going to buy that new thing. Maybe we're not going to go on that cruise. Maybe we're, that's going to slow down the economy, which is then going to require more stimulus from maybe even some quantitative easing type things and create even lower rates. So it's interesting. Yeah. Or go into more significant quantitative easing stuff that we've seen in the past, because this could, we're teed up in a way. And there's so much uncertainty with political things happening that we haven't seen in decades, long time, if not ever, maybe. Like, we are possibly going into one of the most significant recessions in American history right now.
What do you guys think about, because like last year and the year before that, the hot topic of discussion was inflation.
Mm-hmm.
And it seems like that's kind of dwindled the past couple of months. These tariffs, I mean, don't you think that could be inflationary data, though, if countries outside of the U.S. are now inflating their prices because of these tariffs? And does that become an issue? And then a second part, bolt onto this question, is then does that create something like we saw in the 80s where there were 2 recessions that hit relatively quick because inflation came rearing back?
Yeah.
Do we think that's a possibility, or what are our thoughts
Well, I
there?
think the point of his retaliation tariffs is they're based on, and correct me if I understood this incorrectly, but they're based on the tariffs that they charge us as the U.S.
Well, kind of.
In
But
a
the way
way.
he calculated tariffs was basically taking a formula of our, I think it was either our imports or exports, I can't remember, minus our deficit with the country, and then
Yeah, it's
that
complex.
was or divided by, excuse me,
Yeah.
by our deficit, and that equaled a percentage. And then he said that is effectively what the tariff you're even if that's not the actual tariff they're charging, but effectively that's the tariff you're charging because of your laws, your manipulation in your currency,
Yeah.
the way that you hire your workers, like child labor and different things in other nations. He's calling that a tariff on the United States, which was the big unexpected issue, and why no one in the markets foresaw such a significant proposal of tariffs, because it's calculated in this
Right.
probably somewhat make sense way, but not foreseeable way. Like, because you can't actually put the number, you can't figure out what the tariffs were being charged on, because we get charged differently on this product than that product, and differently on this
Yeah.
quantity of products than that quantity of products. But the bottom line is, we're getting into a little bit of a rabbit hole here on tariffs. The tariffs are creating support for mortgage rates, and lower mortgage rates with all the pent up demand will create more demand in housing, which will support house prices most likely, but that could be tempered by a recession that causes people to stop. However, people almost don't have a choice to stop because they have all this equity baked in their house and they have debt and they may be losing their job. So it puts them in a position where real estate almost has to trade because people have to pay off their
Things
debt,
pumping, yeah.
and rates are lower, so it's going to inspire others that don't have to pay off debt to make moves anyway. Does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962.
Yeah, to go back to where Tej was going with that, I think I know where you're going with it. Asking if it's going to impact inflation, which could, that has been the reason why, or one of the reasons why mortgage rates have gone up. A lot of experts, and I think we would agree that in the short term, it could push up prices, which could put upward inflationary pressure. But we also have a crumbling job market, which has been, from the Fed's mouth, more important in regards to their monetary policy than actual inflation itself. So I think it could be like in the short term, yeah, you could see prices go up and inflation go up from the tariffs, depending on how it's all negotiated. But in the end, you've got pressure now on U.S. companies, upping their manufacturing, which in the long term could lower inflation like crazy, but then also maybe reduce the costs for trade from foreign nations, which would also bring inflation down in the long term, which is more supportive of lower mortgage rates.
And it's interesting because it seems likely the Fed will dismiss the effect on inflation because of tariffs and not take action like they did before, and instead be paying attention to other variables like employment and things.
Well, and that commentary is huge because remember, we've talked about it's the movement of mortgage rates and mortgage bonds and treasuries in that market mainly comes from the commentary from the Fed. It's not necessarily the policy itself or actual inflation numbers itself.
Well, the markets are literally just a big casino. They're making bets on information and guessing essentially what's going to happen.
Right. Yeah, so I think like the base formula is inflation's high. Okay, you're worried about bonds and treasuries, yields go up. But when you've got commentary and manipulation coming in, that seems to trump, no pun intended, the, I guess base formula of how the markets trade.
Mm-hmm. Mm-hmm. It's way more colorful. One thing that I had on here when I was doing some research is how it could directly impact housing is construction costs. So lumber from Canada and, nails, wherever those are purchased from. Like there are direct implications on housing costs.
Sure.
And I'm talking to builders and they're like, yeah, dude, things are going up. Steel is going up.
Yeah.
Like the costs to build homes are going up. So that's a little bit sketchy.
Where are we at right now? And it's okay if we don't know this, in relation to building costs now versus like the peaks during COVID.
They just keep going up. Building costs.
That was the one thing.
I think if you look,
really
you can pull up a Fred chart.
Mm-hmm.
I don't think they've ever come down.
Wow.
It's just a constant increase of costs all the time. It's labor that is manipulated based on supply and demand. If there's a bunch of demand, labor prices go up. If there's less demand, labor prices go down because they need
So
work.
shouldn't that also support housing prices as well? I mean, if it's too expensive to build, and they're building.
Oh, for sure,
rates
yeah.
go down. That means existing.
But then affordability is an issue. But then if rates come down, maybe that solves affordability. It's
it's
crazy.
such a complex puzzle.
It is, yeah, yeah. But I mean, who knows? That could be huge. It could be another wave of insane amounts of wealth created in real estate.
For sure.
With this, because if rates, we could be facing a time where rates do come down to the historic lows we saw because of the unprecedented things that are happening from a policy standpoint, which is interesting.
Yeah.
Well,
I think builders are going to be careful regardless of how much supply they're adding to the markets, just because they got burned so heavily in 2008. But most of our supplies are still imported for building homes. Like I know we get a lot of our lumber from Canada.
Mm-hmm.
So again, maybe these tariffs in the long term can help U.S. manufacturers pick up the pace, and maybe it lowers cost to build in the future, and affordability can get a little closer to solve.
Yeah, it's the old term, no pain, no gain. Maybe we have the pain now to have the gain later. Maybe.
Yeah, I mean, let's think we were not on a pace of sustainability for sure.
Oh no, we were in a pace like I can't remember who I was talking to, but it's like we weren't in a downward spiral. We were in a freaking Mach 2 nosedive.
Yeah.
To catastrophe. I mean, it was like, and we kind of still are. Hopefully some of this stuff changes it, like with Doge and with the tariffs and stuff. Hopefully we do, because we've needed a ridiculous reset. Like,
and not just U.S., global.
Well, I mean, and the U.S. really is kind of like the catalyst of a global reset.
Yeah. Think of how long we've been waiting for this. I mean, it's been like August of 22.
Yeah.
We're like, okay, any month now. It's like we come to work and just be waiting for it and waiting and waiting. And at some point, it's like, holy shit, we see so many cracks. When is this going to fall out?
Yeah, and we've talked a lot about, like, and the cracks are forming, and there's always a catalyst to this happening, and it just seems probably like the uncertainty of tariffs is going to be that catalyst to the recession. Mm-hmm. But we've talked about, imagine you have, a bow and arrow, and you've got it pulled back, and you just keep pulling back and keep pulling back and keep pulling back and keep pulling back. And we'll just assume this is physics don't matter in this equation. And the tension is so hot. The longer we go, the more tense it gets. The more tense it gets, the further and faster the arrow flies on the other side, which is a little bit scary because I feel like it's the velocity of the recession at this point.
Yeah.
Yeah. Let's not forget that going into COVID, we were in a recession.
Yeah.
And it basically got kicked down the road, which
got swept under the rug with stimulus.
It's going to be bigger.
Yeah.
Now because
maybe that's a good point. Maybe this is like the 80s, and this is the second part of that second recession in the 80s.
I think
you're probably right.
Mm-hmm.
Yeah. It
makes crazy sense. Which, I mean, you always have to think and point back to those points, or those recessions in charts if you're looking at them. It's pain for 5 years, but then it brings the most prosperous times for literally everybody for the next 15 or longer.
And you should go reference some of our other previous episodes that talk about getting proactively ahead with your financing, leveraging our optimized leverage strategies. TJ and I just did a 3-part series on our whole process that we use in guiding our clients. This is one of those times that you need to be ahead of the ball here, and you've got to get yourself prepared, because if we see a drawdown in the stock market of 50% and you don't have some liquidity somewhere and you lose your job, you best case scenario miss out on opportunities that could mean significant financial upside for you. But worst case scenario, you wind up like so many others in these catastrophic recessionary times, bankrupt and losing your home and a lot of chaos and misery because of finances. This is a time to get proactive because it's not really hit yet.
Yeah.
So people still have a chance to leverage that. And that leverage might even mean you sell your house, wipe out your debt, capitalize on some cash, and go buy a new one. Just push the reset button. This is one of those times that you might want to get ahead. But so we are going to conclude this discussion as a part 1 that's centered around tariffs. And then next week, we are going to have a part 2 that we dive into some of the other aspects of the Trump effect on real estate. So stay tuned, but part 1, tariffs, out.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.